Michel, thank you very much. It's delightful to be introduced by you, having worked together on many issues over the years. And good evening, ladies and gentlemen. It really is a great pleasure to have been invited to give this lecture in honor of Tommaso, a great economist, a great public servant, and a great European whose untimely death 4.5 years ago left public and academic life very much the poorer. I had occasionally met Tommaso even before I became chairman of the Financial Services Authority in September 2008. But it was after then that I got to know him well, and we used to meet regularly to discuss the causes and consequences of both the initial crisis of 2007 to 2008 and its profound aftershocks. Whenever he was passing through London, he would give me a call and we would meet and discuss these issues. And in the course of one of those conversations, Tommaso posed a question which struck a chord with me then. I remember thinking that it was a rather deep question and which has stayed in my mind ever since. Have we yet worked out, he asked, whether this was a crisis of specific banks or even of the whole banking system, or whether it was a crisis of a free market financial market system? And I'm going to try this evening to suggest some answers, only partial answers, to that question. Now, Queen Elizabeth famously visited the London School of Economics in 2009, and she herself also asked a very simple question: why did no one see it coming? But if she were to visit again, she could actually ask a further question. For I think there are two questions together which pose a very major challenge to the orthodoxy of finance and macroeconomic theory which prevailed before the crisis. First, why did we not only fail to see the crisis coming, but actually proposed and developed and confidently promulgated theories which assured us that crises had become less likely? Question one. And question two, second, why even after the crisis had occurred, why therefore even in spring 2009, were we so slow to realize how deep the post-crisis recession would be and how slow and weak the recovery? Because I ask you to go back to the IMF documents or the Bank of England documents or the US Treasury or the Federal Reserve documents of spring 2009, and you will find nobody who anticipates that 6 years later, we are still 10 to 15% or 20% below previous trend, and in many countries not yet back to the GDP per capita levels of 2007. Now, my main focus this evening is going to be on the first of those questions, and in particular on the reasons why I believe that financial and risk management innovations which we thought and said had made the system more stable actually made it more unstable. But I will start with some brief comments on the second question, because it too is relevant to the assessment of the net impact of those innovations. So why, 7 years after the crisis, is GDP in many advanced economies still below, GDP per capita in particular, still below 2007 levels? Well, I believe the most fundamental reason for that is illustrated by this exhibit, which shows the growth of private sector debt, and I stress this is private sector debt, not public sector debt, as a percent of GDP in advanced economies over the 6 decades before the crisis. And as you can see, it grows from about 50% in 1950, and it reaches 170% by 2007, and it grows pretty much every year, and it grows at an accelerating pace in the 15 to 20 years before the 2007 crisis. I think this is fundamental. Now, like many others, I have described elsewhere, and in the written script of my lecture, I refer to where elsewhere, to why that growth of leverage and the resulting debt overhang has inevitably driven such a severe post-crisis recession. But very briefly, the essential points of the argument are as follows. Most of this rising leverage arose from lending against real estate. I'll come back to that later. With credit growth driving real estate prices increases and rising real estate prices driving credit growth in very strong self-reinforcing cycles. And an interesting point about rising leverage of that form is that it doesn't produce alarm bells in inflation targeting central banks because it doesn't produce an increase of current price inflation. It produces asset price inflation. So we had these very strong increases in leverage of a particular form which did not produce inflation, to which inflation targeting central banks felt the need to respond. But high leverage did leave the economies very vulnerable to financial crisis and then to post-crisis deleveraging and deflation. For once you've got high leverage, if at any time there is a financial shock or some other setback to confidence, the higher the level of real economy leverage at which that shock occurred, the more severe and difficult will be the post-crisis recovery and adjustment. And that is because in the aftermath of the crisis, companies and households which previously felt confident with that rising leverage suddenly become aware of their leverage and determined to pay down debt. And so companies cut investment and households cut consumption, and as a result, they drive the economy into recession. That is the story told, I think, compellingly by Richard Koo in his great book on the Holy Grail of macroeconomics about the Japanese experience in the 1990s. And it is the story told very compellingly, but what I think was probably the best book of 2014 in the economic sphere, which is Atif Mian and Amir Sufi's book on the US debt overhang, House of Debt. And the problem is that once you have that debt overhang and the determination of companies or households to pay down debt, we seem to enter an environment where all our standard policy levers seem either blocked or imperfectly effective. So faced with reduced private demand, what happens immediately is that public sector deficits naturally and indeed initially usefully expand, offsetting the demand impact of private deleveraging, but with the inevitable consequence that public debts increase. Indeed, the fundamental fact of the last 7 or 8 years, is that debt has not decreased. It has simply moved around the economy from the private to the public sector or from Germany to China. But at the level of the world economy, as both the recent Geneva report and the recent McKinsey report set out, the total level of leverage globally has just gone up and up and up. So at that point, it feels that fiscal consolidation, fiscal austerity is essential, and so instead we seek to stimulate the economy by using ultra-loose monetary policy. But ultra-loose monetary policy may well produce asset price bubbles and risky financial engineering long before it stimulates the real economy. And crucially, there's a fundamental irony of ultra-loose monetary policy, which is that it only can be effective in re-stimulating the real economy by re-stimulating the very growth of private leverage, which first got us into the mess. In sum, therefore, I think the core of why we are in a difficult position is that excessive private leverage growth before the crisis has left us facing a huge debt overhang from which we are still struggling to recover and which we will probably still be struggling to recover for several years yet. But what is striking is that before the crisis, this dramatic growth of leverage produced very little concern in policy-making circles or in academia. Instead, two benign views of debt accumulation tended to dominate. First, within finance theory, the focus was almost entirely on the positive role that debt contracts play, and on the problems which arise if banking systems and debt capital markets are underdeveloped. So if you were to look at a review of the literature, take for instance Ross Levine's meta-review of the whole of the literature and all the econometric results in 2005 in the Handbook of Economics, you will find that he describes how both narrative economic history and econometric analysis suggest that financial deepening, both in general and measured quite explicitly by increasing private sector debt as a percent of GDP, is positive for growth. It's written in 2005, and it's all about, look at India, its private sector GDP is only 10%, it would grow faster if it was 50%. There is no focus at all on, but there are some other countries which left 50% way, way behind them and are now at 170%. Meanwhile, down at the other end of the academic corridor, where the macroeconomic and monetary theorists hung out, the predominant assumption was that the details of the financial system and the role of banks and credit could be almost entirely ignored. As Mervyn King put it in a lecture in 2012, and I quote, "The dominant new Keynesian model of macroeconomics lacks an account of financial intermediation so that banks, credit and money play no meaningful role. The central banks and the monetary economists largely simply ignored what was happening and leverage. They were convinced that provided low and stable inflation was achieved, the level of leverage appeared to have no implications for macroeconomic stability. And if the finance theorists down at the other end of the corridor said that it was good for efficiency and good for the effective mobilization of capital, then clearly everybody was happy with growing leverage. So the growth of finance vis-a-vis the real economy was thus seen as positive. But so too it was believed, and this I now turn to my main topic for this evening, so too it was believed were the developments occurring within the financial system itself in the very specific way that additional leverage was provided in how we did credit intermediation. For what is striking is that alongside the growth of real economy leverage, which I set out in my first exhibit, the 30 years or so, or maybe 40 years, from about 1971-70 onwards, those 40 years running up to the crisis also saw an extraordinary explosion in the internal complexity of the financial system. So that if you look at these figures for the US, you can see a significant growth in corporate leverage, a significant growth in household leverage, but by far the biggest increase in the total amount of financial assets in the economy was explained by the leverage of the financial system itself and the contracts that it had vis-a-vis the rest of the financial system. Essentially what happened is that the financial institutions traded or contracted far more intensely with one another as well as with the real economy. For each unit of credit extended to the real economy, the financial system also did more and much more complex activities with itself. Now, this growing complexity within the financial system reflected two developments. First, the emergence of securitized credit, with an increasing percentage of that credit in the real economy, and in particular the household credit, packaged into tradable credit securities, which rather than being held to maturity on one bank balance sheet, might then be passed through multiple step distribution channels or traded backward and forth between many banks and non-banks. We went from an environment where mortgages basically were originated and set on one bank balance sheet to one where they could pass through tens of balance sheets in the course of their life, creating as they went large amounts of intra-financial system complexity. And secondly, the emergence of derivative markets through which firms could hedge risks, but which they could also use to place position-taking bets. As a result, the system became massively, indeed I would say mind-bogglingly complex and difficult to understand. So complex indeed that there is a report by the Federal Reserve Bank of New York which attempted to map all the interconnections possible within the so-called shadow banking system, where in the final paragraph of that report there is one of the oddest recommendations that I have ever seen in an official report. What they say is, we recommend that anybody wishing to understand this system should print the Exhibit X on a poster 4 foot by 3 foot, because if you print it on anything smaller, you will not be able to understand the system. And indeed, this is available in a room at the Federal Reserve, and you can go and say, oh, what's happening down at this level? I'll put this up later, and you can all come and study it, and then there'll be a quiz later to see whether you've got the answer. But what was interesting is that this extraordinary increase in complexity was also seen as largely positive. And leading authorities were confident that the new system was both less risky and more efficient. It was perceived as being less risky because it, in the famous phrase, sliced and diced risks and distributed into the hands of those best placed to absorb and manage it. And it was seen as more efficient since it brought the power of liquid markets to drive more efficient price discovery. Thus, for instance, if you were to have picked up in April 2006, only 15 months before the onset of a huge financial crisis, if you had then picked up the Global Financial Stability Review of the IMF, you would have found them noting with approval the fact that credit derivatives, quote, enhance the transparency of the market collective view of credit risks, provide valuable information about broad credit conditions, and increasingly set the marginal price of credit. So what they're saying there, increasingly banks don't have to do their own credit analysis. They can simply observe the wisdom of the market as expressed in credit securities prices and credit securities spreads, and that's the appropriate price of credit. But it went on to confidently assert that there is a growing recognition that the dispersal of credit risk by banks to a broader and more diverse set of investors, rather than warehousing such risks on their balance sheets, has helped to make the banking and overall financial system more resilient. The improved resilience may be seen in fewer bank failures and more consistent credit provision. Consequently, the commercial banks may be less vulnerable today to credit or economic shocks. Now, I have a fear that the person who actually wrote these words is now chained up to a wall in the dungeons of the IMF and is not allowed out any longer. So embarrassing is it to the IMF. But these statements reflected a very dominant consensus based on the strong theoretical propositions of rational human behavior and efficient markets. For if it is the case that human behavior is predominantly rational and markets essentially efficient, then it would follow that market completion, which is the ability to make a wide as possible array of market contracts, and increased market liquidity, the ability always to trade positions in liquid and transparent markets which foster efficient price discovery, if the fundamental propositions of rationality and efficiency held, then it would follow inevitably that this increased complexity would produce both increased allocative efficiency and a more effective management of risk. So in one sense, confidence that the increased complexity was making the world a better place essentially relied on an axiomatic assumption that because we knew the world was rational and because we knew the world was efficient, then more contracts must be good. But it also reflected a belief that even if this complexity had inevitably created some new risks, we had developed an increasingly sophisticated set of tools through which to manage those risks. Alan Greenspan in 2005 lauded the positive benefits of the more complicated credit intermediation system, and in particular, the increasing use of derivatives. And one reason why he was confident that these had improved allocative efficiency without increased was that they had been accompanied by, and I quote, the related application of more sophisticated methods for measuring and managing risk. And there were 4 tools in particular. It's essentially 3 and then I split one into 2, but 4 in particular were widely lauded as important. First, the far greater use of collateralization in interbank lending and interfinancial firm contracting and in derivatives and other contracts. So if I go back to that explosion in intra-financial complexity that I showed earlier, only a small proportion of that was an increase in the size of the unsecured interbank lending market. Most of it took the form of a variety of forms of secured lending. Second, the application within that secured lending of haircuts to ensure that collateral was always more than enough to cover the lending or other contractual exposure, with collateral then revalued daily or at least frequently on a mark-to-market basis so that margin could be called to maintain desired percentage haircuts in the face of changing market prices. Thirdly, the still more general application of mark-to-market techniques, not just to value collateral in secured contracts, but generally, ensuring that there was always a clear understanding of the true market value of all positions and therefore of capital requirements, profitability and risks. And fourth, the use of value at risk models to provide a scientific basis for determining how large the percentage haircuts were required to cover likely short-term movements in market prices. These tools were meant to make the financial system safer. But I want to argue that, in fact, they made the financial system more unstable, and that in 2008 they combined to produce what can only be called a financial doomsday machine. That's because they took the inherent procyclicality of any credit system, hardwired it into contractual relationships, and thereby turbocharged it. Now, what we have to recognize is that financial crises and then post-crisis recession, which were driven by excessive credit creation and by post-crisis overhang and deficiencies in either credit supply or demand, well, of course, they occurred long before we had complex packaged and structured derivatives, before derivatives, securities, before derivatives, before VaR-based models. If I look back at the Japanese banking and real estate boom and bust of the 1980s or the 1990s, or the Scandinavian boom and bust of the early 1990s, they managed to achieve that with traditional old on-balance sheet lending with not a CDO or a CDS or a VaR model anywhere in sight. So clearly, classic old on-balance sheet banking was capable of blowing up. And at the core of financial instability, in both these crises and in our latest, lies a powerful self-reinforcing interaction between credit supply and demand and the price of assets whose short-term supply is significantly inelastic. And that, above all, means real estate assets, locationally specific urban real estate. The textbook function of credit, and this really is what bank credit and capital market credit is described in if you pick up an undergraduate textbook. The textbook function is to finance new capital investment by entrepreneurs stroke businesses. So our textbooks with which we teach young finance students and economists says banks take money usually from householders and they lend it to entrepreneurs stroke businesses, thus allocating capital between alternative capital investment projects. But as economists such as Oscar Jorda, Maurice Schullerich and Alan Taylor have shown in a very fine piece of work, which looks at 17 advanced economies going back to 1870, most credit in advanced economies, whether extended by capital markets or by banks, has very little to do with that textbook function, but instead primarily funds a competition between ourselves for the purchase of assets which already exist, and above all, for existing real estate assets and the locationally specific and inelastic supply urban land on which the real estate sits. And when credit is extended to finance the purchase of inelastic supply assets, it will inevitably, by being extended, produce asset price increases, which, working through both net worth and expectation effects, induce both greater credit supply and further credit demand. On the credit supply side, which is the outer circle of this exhibit, increasing real estate prices induced by increased credit supply help produce temporarily low credit losses, which increase banks' capital and thus their lending capacity, and which induce in the minds of bank loan officers and credit controllers the belief that extending yet more money to lend against real estate would be a thoroughly good idea. On the demand side, the inner circle, increased real estate prices increase the net worth of borrowers and thus their borrowing capacity and induce expectations of further price increases, making it apparently rational to borrow more money to increase investment in real estate. The inherent tendency is hugely procyclical, and it produces again and again an extraordinarily strong correlation between credit growth and real estate prices. And it explains why credit and real estate price cycles, as has been shown by Claudio Borio and others at the BIS, those cycles are not just part of the story of financial and macroeconomic instability in modern economies. They are again and again pretty much the whole story of where financial instability comes from. Because after the upswing of the cycle, there is inevitably what some would call a Minsky moment, which produces a crisis of confidence, falling prices, rising losses, swinging the cycle into a strongly deflationary reverse. Now, this pro-cyclical instability produced banking crises and post-crisis recessions long before securitization, derivatives, and sophisticated risk management tools were ever invented. But I think what we have to recognize is that the tools which we developed to deal with the increasing complexity of a securitized credit system took this pro-cyclicality and they made it worse. For in a system of secured lending and other contracts, in which collateral is continually revalued on a mark-to-market basis, the link between rising asset prices, apparent net worth, and price expectations is made stronger and more immediate. There isn't a delay in which people understand what's going on. It's happening day by day in the process of the revaluation of positions. Mark-to-market in accounting in a rising market, as the bottom lozenge there, swells trading profits and bank net worth, increasing bank capacity to lend and trade. Rising prices for collateral increase for any given percentage haircut the amount of trading that can be supported, potentially driving yet further price increases. And rising prices in transparent liquid markets generate expectations of further asset price increases, increasing the apparent incentive to lend, borrow, and trade yet further. Meanwhile, crucially, value at risk models give a further twist to this amplified pro-cyclicality. More trading in the upswing of the cycle tends to produce a reduction in volatility, which suggests via value at risk models that forward-looking risks have been reduced, making it possible to reduce the percentage haircuts and thus making it possible to support yet more trading of any given value of collateral. I think it is the case that a system of traded credit securities and derivative contracts underpinned by collateralization, mark-to-market accounting, and value at risk models is bound to produce yet stronger pro-cyclicality than even on-balance sheet banking systems, both in the upswing of the cycle and, crucially, in the downswing. Because in the downswing of the price cycle, falling asset prices drive reductions in collateral value, provoking margin calls and expectations of further price falls, as a result reducing both the capacity and the apparent incentive for trading activity and lending activity, and as a result producing yet further price reductions. And VAR-based models powerfully intensify the downward cycle, since increased volatility suggests the need for much higher percentage haircuts. And that system played a major role in the initial instability of 2007 and its application during 2008. As has been pointed out, for instance, by Gorton and Metric in their very fine article on the run on repo, what we faced in autumn 2008 was not initially a classic bank run of a removal of unsecured retail deposits, or even initially a bank run in corporate or unsecured institutional deposits, but a run in the secured financial system itself, a run on repo. As we saw these extraordinary explosions of required haircuts on repo transactions, which before the crisis had fallen to ludicrously low levels and then which overacted in the other direction. So apparently valuable tools helped make the whole system more unstable. But it's worthwhile stepping back first to ask, how is that possible given our economic theories? And then, finally, what consequences follow for appropriate policy? I step back to what I said earlier. If the principles of the rational expectation hypothesis and the efficient market hypothesis held, then it is clearly the case that the more active trading of credit securities and derivatives combined with the professional application of new risk management tools, including value-at-risk models, would make the system safer. If markets efficiently reflect fundamental values with prices resulting from the interaction of rational forward-looking agents, and if assessments of future trading risks can be based on the observation of the probability distribution of recent actual results, then it would clearly follow that mark-to-market accounting, collateralized contracts, and haircuts determined by value-at-risk models would ensure an efficient and optimal result. But the problem is that in the real world, the propositions of the rational expectation hypothesis and the efficient market hypothesis are, I believe, unconvincing and essentially untrue. Liquid financial markets are, I think, to a degree, always inefficient. They can be subject, as economists such as Robert Shiller have clearly demonstrated, to surges of irrational exuberance and despair which take prices far from equilibrium levels. There is, I believe, for instance, no explanation whatsoever rooted in a rational forward-looking assessment of prospective cash flows which can explain why the Nasdaq went from 1,500 in 1998 to 5,000 in April 2000 and then back to 1,500 in 2000. Instead, to explain that, we have to understand that liquid financial markets can be driven by self-reinforcing herd effects or by what George Soros calls reflective processes. And we have some pretty good understanding, basic understanding, of why that is bound to be the case. In part, it is because human beings, even individually, are not wholly rational. They have a part of their brain which is capable of rational ratiocination and other parts which are limbic and deeply emotional. In a wonderful phrase of Andy Haldane, when we are engaged in financial markets, we are literally of two minds. Secondly, however, and these are the great insights of people like Joe Stiglitz in his Nobel Prize lecture, even if we were wholly rational as individuals, it can be perfectly rational in a world of imperfect information to respond to others' information and action in a fashion which generates self-reinforcing effects. All financial markets are therefore potentially irrational and subject to irrational exuberance. But the good news is that in some markets, and in particular the equity market, that inherent instability usually does not produce severe macroeconomic harm. So we see here, the Nasdaq index soared and then fell. Many people made a lot of money. Some other people lost a lot of money. Quite a lot of real resources were squandered on business projects which went bust. But the Nasdaq's fall induced neither a financial crisis nor a prolonged recession. And the market's irrational upswing helped fund investment, which left us with the innovative applications of the internet. Now, a perfect planner could have done better than this, but in her absence, the inevitably chaotic processes of market capital allocation through financial markets still delivered a net beneficial result. But the crucial point is that when the inherent irrationality of liquid financial market affects the market for credit, not equities, that is when we can have severe economic harm. For in credit markets, I think the crucial insight, and the economist Andrei Schleifer has set this out, is that irrational exuberance cannot simply produce the mispricing of contracts, but the proliferation of contracts which, in his terms, owe their very existence to neglected risks. Contracts, debt, loans from one person to another, which in a rational, efficient world would never have existed. And that has a different effect from the mispricing of an equity contract which should have existed, but simply happened to be mispriced. It is that which can produce excessive credit creation and a severe debt overhang which produces severe macroeconomic harm. That indeed illustrates the general principle that if markets are potentially inefficient and irrational, more transparency, more liquidity, and more sophisticated risk management tools can paradoxically make the system less rather than more stable. And if markets are inevitably imperfect and potentially irrational, I think we have to realize that the application of value-at-risk models can have a harmful effect. Now, what went wrong with value-at-risk models was partly a set of technical problems in their design. I think we know in retrospect that it was quite wrong to assume, for reasons of simple mathematical tractability, that the distributions of returns were normal, when any reasonable analysis of past returns will tell us that we faced lots of non-normality, fat tails and extreme events. I think it was also absolutely absurd that some VAR-based models were based on observing price movements over the last year or even the last month and failing to take account of the observable movements in prices which had been seen over the last 10 or 20 years when more extreme events would have been seen. But at least those technical problems can be to a degree mitigated by non-normal distributions and by basing VAR-based estimates on longer time series and looking at past extreme events. But even as we do that, I think it is important to recognize that any improvements will be imperfect, because VAR-based models suffer from a still deeper deficiency. They are based, and we sometimes don't step back and think about it, but they are based on the assumption that recent past observed events can be treated as a sample from an unchanging but given universe of possible results, and that we can thus think about risk in a quantifiable probabilistic fashion. But the key point is that no such unchanging universe exists, and the future is governed not by stochastic probability, but by inherent and irreducible uncertainty. As John Maynard Keynes put it, human decisions affecting the future, whether personal, political, or economic, cannot depend on strict mathematical expectations, since the basis for making such calculations does not exist. And as Mervyn King put it in a lecture in 2010 on the role of uncertainty in macroeconomics, there are actually probably very few genuinely deep and therefore stable parameters or relationships in economics, as distinct from in the physical sciences, where the laws of gravity are as good an approximation to reality one day as the next. Now, some people will of course point out that if you really go to the deep level of physics, you then face uncertainty at a Heisenbergian level of quantum economics. But as Mervyn says, that may be true, and very fine theoretical economists may need to worry about that. But for day-to-day operation, we can pretty much assume that the laws of gravity are the same this day as the next. But economic relations are somewhat different. And once we recognize that human beings are in part irrational, markets inherently imperfect, and the future is governed by uncertainty, not by stochastic risk, the axiomatic assumption that increased market completion and liquidity will produce benefits is wrong. And I think the crucial thing to realize is that in the face of that reality, there are no risk management tools which will make the risks disappear. And the danger of a delusion that apparently sophisticated tools will magnify systemic risk. Though with an incredibly important irony, which is that for each individual player in the market, it was entirely rational and remains entirely rational to introduce and deploy these technologies, and that for each individual player, the more adeptly they use the tools, the better would be their relative position. The economist Hyun Shin has likened instability in secured funding markets to the alarming and self-reinforcing wobble which afflicted London's new Millennium Bridge when it first opened in 2000. Initially, random patterns of pedestrian weight distribution as people walked across that bridge could produce initial wobbles which worried and disoriented people. But the problem was that the way that people then responded to that, moving their weight from one side to the other, could actually make the wobble worse. Now, the crucial thing to understand is that some people in such an environment will be more adept at others, better able to move their weight and keep their balance. Others may be absolutely useless at that process and may actually fall over. But you have to understand that the movements of the successful contribute as much to the collective instability as the movements of the incompetent. Similarly, in the financial crisis, there were certainly incompetents who did worse than others. The FSA report on the failure of RBS, for instance, illustrated how RBS's application of mark-to-market disciplines fell short of best practice, leaving it ill-equipped to respond rapidly to changing market prices during 2007-8, and leaving it holding the positions which the more adept firms had realized were going wrong and had offloaded onto the inept. But the crucial point is that the activities of those more adept players who used mark-to-market disciplines effectively to guide their trading strategies and who managed their trading positions more aggressively and who as a result were the survivors of the carnage of 2008, their actions contributed as much to the systemic instability as the actions of the incompetent. A crucial implication for policy follows. Better risk management by individual firms cannot make the financial system more stable. If you say the solution to financial instability is to get everybody to best practice in risk management, what you're saying is that on the Millennium Bridge, you're going to get everybody the person who responds immediately. Well, you'll get a very wobbling bridge. And the key policy responses to potential instability must therefore be at the macro, not the micro level. My argument this evening is not, therefore, that we should jettison the risk management tools which we wrongly assumed would deliver systemic stability, but we need to recognise their inherent limitations. Mark-to-market accounting has a vital role to play in individual firm risk management and in some environments is the only sensible accounting approach. If a financial firm takes short or medium-term positions in tradable securities, whether debt or equity, the only sensible measure of the current value of those positions is the best value at which they can be sold. Equally, it is clearly rational for many financial participants to seek individual security through taking collateral requiring haircuts and marginal calls. And though I have criticised VaR-based models, provided they are used in a fashion which recognises non-normal distributions and extreme events, they are probably the best imperfect ways to estimate trading risk in a world where there are no perfect answers. So having, as it were, come to criticise over-reliance on this trio of tools, it is not my intention to bury them, but instead to argue that their use must be combined with very strong macro-prudential tools designed to lean against the strength of credit and asset price cycles, whether arising in a traditional on-balance sheet form or in a securitized trading form. And in the case of securitized credit trading, that implies much higher requirements for trading book capital than were in place before the crisis, and with regulators able to vary those minimum requirements in a counter-cyclical fashion to slow down exuberance in the same way that they can now vary general capital requirements via the counter-cyclical capital buffer. Second, very tight controls on the rehypothecation of collateral to prevent the same collateral being used to support multiple secured financing contracts, and thus, by constraints on that rehypothecation, to discourage the proliferation and expansion of complex multi-step distribution chains. Third, a strong challenge to the special treatment within bankruptcy of collateral used in specific contract markets, such as the repo markets, which, as economists such as Enrico Perotti have argued, provide what I think is a completely unjustified privilege for one class of creditors over another, but which therefore makes it essential for all the other creditors to also seek a security in a sort of nuclear arms race of collateral pursuit. And finally, the regulation across multiple trading markets of minimum percentage haircut requirements, overriding the inevitable pro-cyclical output of VaR-based models and preventing haircuts from falling to very low levels in the upswing of the cycle. Essentially, putting in the upswing of the cycle a set of regulations that says, no, you can't have 1% haircuts, even if that model is what that tells you is appropriate. Such measures are the equivalent for trading markets and for shadow banking of the Basel III package of balance sheet capital and liquidity requirements. They need to be strongly calibrated and enforced. Such reforms are, however, often resisted, since it's said they'll reduce market liquidity, having a chilling effect on financial innovation and make it more difficult to achieve, through trading and hedging, optimal combinations of risk return and optimal price discovery. But I think their idea that there were inevitable and great social benefits from increased liquidity and market completion was a pre-crisis delusion. And I think the financial innovations which it fostered delivered significant harm. The robustness of our policy response in this arena should not therefore be constrained by concerns that trading activity will as a result decline or that financial innovation will face a somewhat chilly wind. But although I doubt many of the claims of financial innovation set out in those quotes from the IMF I showed you earlier, one claim for financial innovation which was made turned out to be true. It was said that credit securitization would facilitate additional credit expansion. Thus, for instance, a paper published by Goldman Sachs in 2004 entitled "How Capital Markets Enhance Economic Performance and Facilitate Job Creation" welcomed the fact, and I quote, "The revolution in mortgage finance has increased the ability of households to purchase their own homes. At time, borrowers can obtain 100% financing." That, to this article, was the great benefit of securitization. Boring old on-balance sheet bankers, they'd stopped at 90%, but with securities, we could go all the way to 100%. And it is true that the securitized trading and distribution of credit securities made it easier to extend private credit, which is why we see in the last 20 years before the crisis, not only the continuation of the growth of private leverage, but its significant acceleration. And remember that pre-crisis finance theory had tended to assume that financial deepening, higher private credit to GDP, was beneficial. But if, as I argued earlier, the severity of the post-crisis recession is primarily explained by the sheer quantity of debt created and the level of leverage which resulted, it would have been better if that easier credit creation had not been enabled. If securitization enabled 100% mortgages, we'd have been better off without securitization. Financial intensity within the system and the techniques we developed to deal with it, therefore, I believe, both made the financial system itself more unstable and facilitated the creation of a level of leverage which increased the severity of the post-crisis recession. I think it was therefore central both to the question that the Queen did ask and the additional one she could ask if she would return to the LSE today. But what of Tommaso's question? Have we worked out whether this was a crisis of specific banks or even the whole banking system, or whether it was the crisis of a financial market system in total? Well, sadly, I am unable now to give him my answer in person. But the answer I would give, if I could, is that this was a crisis whose roots lay in something well familiar, the inherent instability of any credit creation system, magnified by the increasing role of traded markets in credit securities, and made worse by the very techniques which we thought had made the system more stable. And that in response to that reality, there remains, beyond Basel III, an important area of financial regulation which we still need to get right. Thank you very much.